I'm gonna go over 4 HSA loophole strategies you probably don't know about. Now, a lot of people know that an HSA gives you triple threat tax benefits. I put the money in, I get a tax deduction. As I invest it, it grows and I pay no taxes I'm investing. And then it comes out tax-free for medical. But there's 4 more strategies you probably don't even know about that can apply to the HSA. To dig into those strategies in today's video, I'm Matt Sorensen. Let's build wealth. The first one's for any of you starting an HSA and you have your first high deductible plan. There's something called the last month rule that says, hey, if you have a high deductible plan, as long as you have it set up by December 1st in the year, so for example, 2024, as long as I have it set up by December 1st, 2024, I can make a full year's worth of contributions into the HSA, which is $4,150 for individuals, $8,300 for family. Typically in an HSA, you have to prorate your contribution based on the time you have a high deductible plan. But your first year, when you open it up and you have a high deductible plan, you get to do this last month rule, which a lot of people are using right now, setting up an HSA qualifying plan. Now that contribution doesn't even have to go in until April 15th of 2025. This is a strategy a lot of people miss because they read the pro rata rule and think, oh, it's my first year. I can only do 1/12 of 8,350 for my family. It's not that much money, and they totally blow it. Make sure you understand the last month rule to get the full contribution in. The second loophole you may not know about for an HSA is the ability to take distributions tax-free for medical whenever you want. You don't have to take it in the year you incur it. So for example, if I have a ton of medical in 2024 and I have an HSA account, I can take out the money and reimburse it. It comes out totally tax-free. Or I can wait and take the money out 10 years from now. Let me keep that money in the HSA, keep it investing and growing, building tax-free. I'm still working, making money. Let this money ride and stay invested, and I can pull it out later. So long as you have an HSA when you're incurring the medical expenses, you can let that money stay invested, ride, and you can take the withdrawal tax-free whenever you want later on. So let me break this down for you, why this could be beneficial to you. Let's say you're putting $8,000 a year into your HSA. Okay, the annual contribution is $8,350. Let's just keep it simple. And you're doing this for 20 years. So I'm gonna have $160,000 of contributions into my HSA over that 20-year window. Now let's say I'm investing it in the S&P 500 or some other investment that's getting me a 10% return. By the way, you can self-direct it, invest in crypto, alternative assets. I'm going to come to that in a minute. But let's just say you're investing it in the stock market or in some fund getting a 10% return. Now, if you look at the calculator here, that's going to give you $344,000 of investment returns. So my HSA account is going to be over $500,000 if I let all that money stay invested, continuing to grow, building up. I'm paying zero tax as I'm growing that money, and I'm not taking it out for my qualifying medical, but I am tracking my receipts and all my medical expenses because I'm going to take it out later. Now let me show you the difference if you started pulling this out. Let's say you were putting in the $8,000 a year into the HSA, but you were pulling out half of that every year for your dental, for your medical, for your kid, for you or your spouse. So you're putting $8,000 in, but you had $4,000 of annual medical expenses. So you only really had $4,000 being invested every year. Well, if I do that over 20 years, that's $80,000 of contributions. And now my HSA account's only $282,000. I've left so much money on the table. I left over $150,000 in tax-free gains that I could have got if I let the money stay invested. So a lot of our smart and sophisticated clients use the HSA as the way to grow money tax-free. They know they can pull the money out later. Let's say you're 35 years old and you're like, well, I want to pull the money out when I'm 40 or 50 or 55. Just because you have medical when you're 35 doesn't mean you need to pull it out of your HSA that year. Let the money stay investing. Pull it out 10 years, 20 years, 30 years later. There's no age limit on when you pull money out of the HSA as long as it's for a qualifying medical expense. But that medical expense only has to be incurred at a time you had the HSA. So for those that like to put money away and grow in a tax-free manner, use the HSA as a save and build strategy, not as a save and spend strategy. I want you to continue to build and grow this tax-free wealth, have a $500,000 HSA in 20 years as opposed to $282,000. So think about it this way. If you have a $1,000 medical expense, you can pull it out of your HSA and it's going to deplete the amount of tax-free growth you can have in the HSA because now you have $1,000 not growing tax-free anymore. But you still have to pay the medical bill of $1,000. But I'd rather pay that of my savings and other money that would go into a taxable brokerage account, which I will pay taxes as I grow and earn money on it. I want my money working and building for me tax-free, so I get to keep all the returns and gains rather than putting it in a taxable brokerage or other investment account where I'm paying the government 30% as I'm making money and I get to keep maybe 70% of the returns and growth. There's a huge difference in what you get to keep at the end of the day by using the HSA, a tax-free growing vehicle. The third loophole loophole for the HSA is the ability to do a one-time transfer from your traditional IRA dollars to an HSA for the annual contribution amount. Now, let's say you're in the situation where you don't have much money in an HSA, or maybe you've depleted it for medical expenses, but you have money in a traditional IRA. Let's say you needed $5,000 for some medical expense. Well, if you had a family HSA plan that year, you could move up to the annual contribution limit, $8,350, from the traditional IRA over to your HSA, no tax. Now the money comes out of my HSA tax-free. See, if I took that $5,000 in the traditional IRA and I took a distribution, so I'm not 59 and a half, and I paid the medical, I'm going to pay an early withdrawal penalty of 10%, taxes on the distribution. It's a terrible outcome, but I can still access that money in the traditional IRA to pay some medical. I do this one-time transfer from the traditional IRA over to the HSA, and then I pay it out of the HSA account because I have a qualifying medical expense. That's another loophole and workaround where you can use your traditional IRA dollars to actually cover your medical. Now, the fourth loophole on the HSA is investing in what you want. A lot of people think of an HSA and it's just going in a savings account making nothing. Maybe you got a brokerage account, they're doing stocks or ETFs, and that's fine too. That money's at least investing and growing if you're not using it for your medical. But there's a better way. You can have what's called a self-directed HSA and invest it into real estate, small business, private equity. My HSA owns crypto. Your health savings account doesn't have to be just in a bank making nothing, or a brokerage account buying stocks that you might already have too much of it or not know what to do. You can invest it in self-directed alternative assets. It's called a self-directed HSA. And it's what we do at our company, Directed IRA, every day. Now make sure you subscribe to the channel. I have so much more content on saving taxes, protecting your wealth, building and growing your retirement. I'm Matt Sorensen. See you next time.